All right, welcome everyone. Thank you for coming out to the VEA's fifth talk of the spring 2021 semester. My name is Christian Moran, and I'm the president of the VEA. If you have any questions, feel free to unmute during the Q&A session to ask them. Today's speaker is Professor Vernon Smith. Professor Smith received a bachelor's in electrical engineering from Caltech, a master's in economics from the University of Kansas, and a PhD in economics from Harvard University. His professional career is marked by numerous esteemed universities and institutions. He has also served on many distinguished boards and won multiple renowned awards, including the Nobel Prize in Economic Sciences in 2002. He currently is a visiting Rasmussen Chair in Economics at the University of Alaska Anchorage and a professor of economics and law, as well as the George L. Ardua Endowed Chair in Finance and Economics at Chapman University. His expertises include experimental economics, ethics and society, Adam Smith, industrial organization, real estate, and economics and law. Professor Smith will scrutinize what process governs price formation and consumer final demand markets. He has found that neoclassical economics misrepresents Adam Smith's classical view and that prices are not given, but rather are found or formed in the market information aggregation process. This perspective was supported by experimenters in the 1950s and 60s. Professor Smith will offer a quantitative theory of classical price formation based on this conception of the role of markets and the corresponding implementation of demand and supply. Professor, thank you again for speaking with us. The camera is now yours.
Well, hi, Christian, and thank you for that introduction. And I'm most happy to do this. We have an economics club also at Chapman. I haven't addressed it for a while, but we sometimes get together evenings. Okay, now this is, the title starts out, it says classical theory. Well, what do I mean by that? Well, I'm talking about classical economics. A lot of students don't study today much in the history of economic thought. So, and the classical economists, those are essentially the scholars in economics who were writing before about 1870. Okay, so that's 150 years ago. The writers in the 1870s became known as the Neoclassical economists. And they were the champions of marginal utility theory. And that's what, and the Neoclassical economists introduced the differential calculus into economics because their way of thinking and modeling lent itself very nicely to differential calculus. So now this talk is about how the classical economists thought about how people finding prices. And by people, we're talking about buyers and sellers. Okay, they come to market. And of course, in those days, and clear up until really about the 1870s in the United States, you shopped in a general store. The general store was owned by the person who managed it. And basically, almost everything was negotiable, you see. So there was a lot of higgling and bargaining. In most of our history, you see, that's been the case. Well, that's still true in the ordinary retail store, or it's not, or it's a little bit less evident. This work is based on it's joint work with Sabayu Inoue. Sabayu is from the former French colony of Niger in West Africa. Well, now, how did we make contact? Well, it's very simple. He wrote me 3 years ago, this coming July. And he introduced himself and he says, I think you might be interested in the attached manuscript. He said, you know, what you did in your market experiments in the 1960s and afterwards, he says, you essentially rediscovered classical economics. Well, that got my attention because I never in the world would have thought about it in that way. But I read his manuscript and he was absolutely correct. And so that's began a enterprise, a joint enterprise that Sabu and I have been exploring ever since. And it's been especially exciting for me because he brought this different perspective, and I immediately realized that the perspective was important, that it was basically correct. And so we've been working these ideas out together. But believe me, this talk would never have been possible without Sabiu. All right, let's, and I want to begin by talking about supply and demand and the way we ordinarily think about it, you see, and ask yourself, how do theorists represent supply? Well, let's just look at the demand side, okay, because that's the main one I want to talk about. How do they represent demand? Well, there's two approaches. Now, the general equilibrium theorists always wrote the quantity as a function of price. Q equals D of P. So the independent variable was price or prices, and if it's more than one product, and the quantities that people buy depend upon those prices. Now, if you look at Marshall, Marshall wrote it the other way around, and there's a stream of and a lot of the textbooks and everything. It's written in the other way, where price depends upon the quantity. Well, they're both incorrect. Okay, and there's a very simple reason for that. Prices cannot be given before people get to market and find those prices. So here we are writing functions that depend upon price as though, think of it, imagine that it's a homework exercise. Okay, before you go to market, conditional upon the prices you will find there, you can compute optimal quantities, and you do this so as to maximize utility. Okay, that's the way neoclassical economists thought about it. But that's basically an error. How can you talk about prices being in the demand function when they don't even exist yet? Now, the classical economists didn't make this error, okay? And the classical economists begin with Adam Smith, The Wealth of Nations. And the theory, all the theory in The Wealth of Nations is essentially in book one, the first 7 chapters. And the chapter 7 is the key one that I'm going to depend on in this talk. Many followers of Adam Smith, particularly the French, were picking up his work already within 25 years after it was published. Okay, within 10 years after his death, they were writing and elaborating and developing his ideas further. And in this stream of thought, this thread about having to do with market price discovery, the function of markets is twofold. First, it aggregates demand and supply. Demand and supply can't be aggregated until people get to the market. You see, assuming each individual, conditional upon price, has an optimal amount that he buys. If you sum that up before people go to market, what's that mean? Because they're going to collectively find the price in general. Now you might say, well, most stores, you see the prices and they were there yesterday. Yes. And of course, if prices remain constant after you find them, then you may very well find that when you go to market, you expect prices to be the same as they were yesterday. But as we saw in the pandemic, you went to the store and there were no paper products on the shelves, and some of those prices in fact rose as the paper started to come back. So there can be disturbances even in that nice world where we expect prices to be stable. There can be disturbances, and immediately markets have to adjust to that. So in general, you always need to be ready to think about prices as a discovery process, because any interference will mean that they'll have to be rediscovered or refound. So it's in the market when people come together, you see that demand and supply gets aggregate, and that's when also that's part of the process of finding prices. When people leave the market after they found them, then you can talk about prices being related to how much they bought. Okay, now that sequence is important because we're talking about a process, you see, and we're going to see how things change in that process. So how did classical economists represent buyers and sellers in consumer markets? Well, they thought of the commodity space as discrete. So in other words, a typical shopping basket has a quart of milk, a pound of bacon, a jar of olives, box of cereal. I buy cereal by the name of Uncle Sam. It's a high fiber cereal with no sugar added. That only comes in one size. It's a small one, and sometimes I get two because there's only about 3 servings in it. But most cereal comes in 2 or 3 different sizes. Okay, but you're buying just one size. Depending upon how often you shop and how big your family is, you may get a large box or a small box. So, but people are making decisions in this discrete space. Almost all shopping baskets in the store has one unit of each item in it. Okay. Now, also the classicals thought of buyers as coming to market with a maximum willingness to pay for anything they buy. And in fact, it's kind of easy if you observe carefully. That's exactly what you see. For example, you find there's lots of shopping baskets that don't have any milk in them on a given day that you go. You've got a quart of milk in your shopping basket. The manager announces that milk is being discounted by 25%. Okay, some people go and get a quart of milk. Someone that already has a quart may even get a second. You see, in retail stores, managers are constantly monitoring their inventories. And if an item, especially something like milk or butter, that can spoil if it's too long in inventory, they lower the price in order to clear those out. So the higgling and bargaining sort of in a modern store has this characteristic, you see. Okay, so now in the aggregate, suppose we have Q buyers and they each are buying 1 unit of some commodity. Now, in the model I'm going to talk about, there's no restriction to 1 unit. People might buy a second or third, but the point is sort of the canonical case. The common case is people are just buying single units. So now think of there being out there a distribution function of values. Distribution functions are increasing. They're ordered from lowest to highest. Well, we turn that around, and buyers are represented by a negative distribution function, because obviously the people with the higher values are the ones that are more likely to buy on any given day, you see, in this distribution function. So think of there being a value as a function, each person with a value, and we've got Q buyers. Okay, just think of that distribution. All right, and that's a distribution from highest value to lowest value. And then similarly on the seller's side, a seller having a minimum willings to accept. Okay, and that in my story about the manager of the grocery store, he changes his minimum willings to accept for milk, because you'll see it's had an inventory buildup on. So these can change. So, but at any one time, we have a distribution function of those costs. And so we can think of C, the cost to the seller. That's just a value, but because he owns it and is giving it up, it becomes a loss. So it's like a cost, and that's a distribution across, the quantities, especially when you have multiple sellers. Okay, so sellers each have a minimum willings to pay. So this demand function, you see, is non-increasing, and that's just an order property of a distribution function. This has nothing to do with diminishing marginal utility. It's the neoclassicals saw commodities as continuous. And so the individual might have diminishing marginal utility for additional units. That has no meaning here if you think of commodities as being discrete, okay? Now, notice here that with value depending upon quantity, that's Marshall's thinking. You see, he put price on the vertical axis. So his thinking is right, but his math was wrong, you see, because you can't have price there yet. Okay. So, and we're essentially looking here, going to be considering Adam Smith, Book 1, Chapter 7, because that's where the notion of willingness to pay appears, and you have a description of how Smith imagines prices being found. Okay, I want to talk about three things. I want to talk about the role of experiments in discovering how the neoclassical paradigm failed to predict experimental outcomes. Well, and I'll go through that. And this is what's interesting about this. What I discovered in my experiments was how well markets work, but how bad the theory was, really, because the theory required all sorts of conditions that weren't true in my market, you see, but that didn't keep people from finding the prices very quickly. I'm going to revisit the classical value theory, okay, the price formation discovery process. I've sketched it, but I'm going to do that a little more in detail. And then finally, I'm going to mathematize the content of classical value theory, and that means just expressing in mathematics the words that we find in Chapter 7. And I think you'll find that you don't have to be a mathematician to see, you see, how those words can be expressed more precisely. Okay, now let's first look at experiments. What were the characteristics and results of the early market experiments? Well, we had small numbers. The first experiment I did, I had 22 people, and by the standards of thinking in those days, that was a small number, okay? We now think of that as a pretty large number in terms of experiments, because people are good at finding prices in markets, even when the numbers are quite small. we used what's called the double auction. That's a multilateral oral outcry bid-ask acceptance trading rules, okay? And since then, all kinds of other institutions of price making have been explored. And basically all of them find the equilibrium, okay? Information is decentralized in that world. Each person comes to the market, if they're a buyer, with their own private value, each seller with their own private value or cost, okay? And they only know their own condition. So there's zero public information, none. Until the first buyer makes a bid or a seller announces an asking price, and then we have public information. Now it's interesting, there's a literature what's called, and among mathematical theorists in economics, that has a bunch of, it's called the no trade theorems. And the argument there is that there's no public information, people can't get off the ground. You can't, there's no way you can make an optimal response. Well, that doesn't really trouble real people. And here's why. Suppose you are willing to pay up to $10 for something and you come to one of these experiments. Look, you're not wanting, suppose you offer to buy for 5 cents and it's worth $10. You're not incurring any risk. Come on, you can always start very low. Sellers can start very high, much above their cost. They don't typically find starts that much above or below their values, but they don't have any trouble figuring that out, okay? And now I want you to note that the subjects in these experiments are not even economics. I'm doing these experiments when I first started, I'm doing on the first day of class, okay? Before anyone has read anything. And people have never, they may have been more likely to have seen one today, but typically people have never seen an auction of any kind, and they're doing that for the first time. Interestingly, they don't have any trouble. They pick up on the auction process very quickly. And to my shock, the very first experiment, the prices converged very close to the competitive equilibrium. And that was predefined by the experiments before I even went in there. So there's no fudging here, okay? These had already been defined, and the value cost environment is defined, and people without any knowledge of that quickly found prices that were very close to that equilibrium. And the bottom line is here, none of us were prepared for this in the middle of the 20th century. No one was. It didn't make any difference where you'd gone to Harvard or Yale or Cambridge University in England. People were getting the same sort of educations everywhere. And it had a real problem, what we were being taught. Now, what were the sources of inspiration in those first experiments that I did, and then also there was someone before me that had influenced me in the first experiment that I did. Well, Jevons, part of the influence came on Jevons. He was writing here in the 1860s and 70s, and he provided the background. He had this model where utility was being maximized given prices. But my first implementations were with discrete units. We just didn't have the technology to do anything with continuous commodity spaces. And so we started with discrete. Unknown to me, that's of course was completely in line with the classical view to do that. Now, quite a bit later, after my first papers, which were in 62, 64, and 65, I wrote a paper called The Theory of Induced Valuation. And I wrote that because economists were having trouble understanding why I was doing experiments. Okay, what do experiments have to do with economics? Okay, well, I told them, I said, you all accept utility theory. Okay, cash has utility. US dollars provides utility to anyone who receives those dollars. So I just make I create a demand and a supply for abstract items in a laboratory environment by paying people dollars depending upon their actions in buying and selling. So what that does, their utility for money induces a utility to take those actions, because those actions have outcomes that are valuable to you. So I was writing here trying to convince, you see, other economists, this is all really very familiar stuff. Well, believe me, if I were to write that paper over today, it'd be a much different paper, you see. That was a very influential paper. It was mentioned by the Nobel Foundation when I received the award. But it's not a paper that I would write in the same way today. Okay, second now, the context here was in the tradition of Marshall, in the way I did the experiments, because Marshall, you see, had called attention to the fact that you think of goods as flowing onto markets from producers, buyers buy them, and basically they eat everything. We're talking about non-durable goods and services, okay? Stuff that can't be stored and can't be retraded. See, nothing in these markets is retraded. Think of hamburgers, haircuts, hotel rooms, airplane seats that you are a passenger on. Those are all perishable, okay? You don't buy them to resell them, you buy them to consume. Well, that's most of private products. If you take the gross domestic product and subtract out government expenditures and call that total private product, 75% of that cannot be retraded. Okay, 25% of it can, like automobiles, houses, that sort of thing. Well, interesting. Almost all the stability in the economy comes from the stuff that can't be traded. Those hold up and do very well even in recessions. The thing that is highly variable and volatile are things like the prices of homes and the prices of automobiles. They will change much more than these other goods. All right. Now, Chamberlain's experiments pioneered this willingness to pay, willingness to accept reservation price procedure. He used what he called tickets. The tickets told people what their value or their cost were. And he pointed out these are, and this is a quote, these are Marshall's demand or supply price. You see, those. So I was influenced by Marshall, so was he also. Now, this is also in the Austrian, the same sorts of discussions are in the Austrian tradition of Menger and von Bauer, but I wasn't influenced by that at the time. But there's a great description in von Bauer's book on price formation in a farmer's horse market. Each person has one horse, okay, that he wants to buy or sell, and it's a great that's a tremendous description based upon willingness to pay values and willingness to accept cost supplies of those who own horses. It's a beautiful description of how prices might form in that market. And these prices are formed endogenously, spontaneously among the participants. That's the thing that impressed me from the very first experiments that I did. How quickly they get into, and there's essentially people, buyers and sellers as a collective, as a group, they're searching for economic value. You see, they're each trying to do the best they can. Buyers are trying to buy cheap, sellers to sell dear, and they have these the tools, that is the oral double auction, you see, gives them a process for sort of exploring how much they can get or not, and for if they have something to sell, or how much they can get if they're there to buy. So, and there's a tendency for these to converge to the law of one price in a market. Now, here's the first experiment I did. This is January 1956. And over on the left is a supply and demand schedule that was distributed among 11 buyers and 11 sellers. No one in the market could see this. Here's a buyer who has a value of $3.25 for 1 unit of the good. Here's one at 3, and so on. This is all they know. That's all the information they have. Here's a seller who's has the same value as this buyer. The difference is that seller has a unit he wants to sell. This buyer doesn't, and is trying to buy one, you see. And so this is the value of the unit to the seller. And well, if he can't sell it for more than that, he's just going to keep it. These sellers down here, because they can get a higher price than the value to them, have an opportunity to gain in this market. Now over here so what exists here? No prices at all. This is I'm just reproducing the error in Marshall when I put price on this vertical axis. There's no prices here. There are values that the buyers have. There are values that the sellers have, okay? And there's a distribution of those. All right, over here on the right diagram, we have prices. That's because people are finding prices. Here's a first trade, a buyer and seller. One of these buyers and one of these sellers is matched at a price, and they trade. And then there's a next price where a buyer and seller are trade, and so on. And notice these start from below, and there's some jitter here, okay, but it is jittering around the market clearing price. Now, I thought there was something wrong with this experiment. This can't be. Okay, how can these people be doing so well? And I realized, I thought there was something wrong with this experiment, and I thought I figured out what it was. There's too much symmetry. Okay, what's the average buyer value? Same as the average seller value or cost, and both of those are equal to the price. I thought there was too much symmetry in this market, and that was just, so I thought these results were just an accident of that symmetry. So very early on, I did another experiment which was asymmetric, and guess what? It converges in about 3 periods also. Okay, so here it is coming up into the equilibrium just about as quick as the first one. There's a lot more room here, a lot more volatility. And notice here, you see the demands, the distribution of values of buyers is very tight. It's all between 360, 370 and about $3 down here, whereas the distribution of the sellers' values is very great, all the way from 20 up to 380. And but nevertheless, it converges quite quickly. Now here is a more recent experiment, and of course we're fast forwarding now to where everything is. We can have electronic assistance in a double oral auction. These are high school students. we do workshops every year, every summer. We do workshops for junior and senior high school students from a broad area, mostly California, but some of them come in from other states. So as the instructor is managing this oral outcry auction, an assistant is typing. If a seller puts in an asking, shouts out an asking price, or a buyer shouts out a bid price, the assistant types those into the computer and they're displayed on the screen exactly as you see them here. That means at the very beginning, you're seeing someone bid here, then they raise the bid, someone else raised the bid. Here's an ask, and a new ask has to be lower than the standing ask on the part of the sellers. At some point, this bid-ask spread narrows to a point where someone accepts. Either a buyer accepts the standing ask or a seller accepts the standing bid. And so we have a contract. And over here, you see buyer 1 and seller 5 are matched in the first contract at a price of $6. And then there's a second one and so on. So that's all people are seeing. They're seeing this in real time. And then because this is a teaching exercise, we impose the supply and demand schedules after the class, after they've finished trading on this market. Notice this is a symmetric case like that first experiment. Notice it's tending to come in from below, exactly like it turns out that's very, very common. Symmetric supply and demand schedules almost always converge to the equilibrium from below, meaning that the buyers are doing better at these contracts here than the sellers, because the contracts are a little below. So if this buyer is matched with this seller, you see, at some price here, many of these contracts are below the equilibrium, so the buyer is doing better than the seller. That's very interesting, because if you ask buyers if they think they're making more money or whether the sellers are making more money, they'll almost always presume that the sellers are doing better. People see markets often as a place where sellers do better than the buyers. And here you see the buyers have no trouble at all taking care of themselves. Okay, well, now what's the mechanism? Here's this market converging. What's explaining that? Well, you see, Valra would say the driver here is the excess demand. If excess demand you see is positive, prices tend to rise. If it's negative, it tends to fall. And and so I looked at that. I did some regressions, did some analysis of the data, in which I took the price change and regressed it on the price in the previous transaction. And well, I'm sorry, not the previous price, but the excess demand. And I found that not a very as good an explanation as this area here, and I call that excess rent. Notice, take the area under the demand schedule and above the supply schedule, and at some price here, which is not an equilibrium price, we can talk about the amount of money being left on the table by all buyers and sellers together if this price doesn't rise. Okay? So at this price, there's excess demand, and also we have a measure here of the profits that will not be captured by the buyers and sellers unless the price moves up. If it comes up here to the equilibrium, you see, then people get they capture all of this profit, this surplus, and nobody in that circumstance can do better than you is done at that equilibrium price. So now, now none of my early experiments were designed to specifically test excess rent versus excess demand. These were just different supply and demand schedules. And I found, though, that the correlation was better across those experiments if I used excess rent than if I just used excess demand. So I asked, how can I design an experiment that would explicitly make a stronger test? And I came up with this design. This is, we call this a swastika. Here's the demand. All the buyers are willing, have the same value. And there's QD buyers, and then there's no more demand. Here, all the sellers have the same cost that we've given them. There's more sellers that are on buyers, and it goes up to here. So this becomes the demand, and this is the supply. Okay. Now notice, though, that if what's ruling here is the excess demand or supply in the market, that's always the same, no matter where the price is. So the forces tending to change price are always the same, no matter what the price is. Whereas the excess rent, if prices fall, this area is declining, and so we expect a different pattern. In fact, this market will tend to converge exponentially, to decay exponentially toward the equilibrium, while this one displays decays at a constant rate. And if you look at these, here's various experiments, you'll see that these are all tending to decay exponentially, you see. It's hard to tell for this case because there's only 2 units in an excess supply. This is 5, and this one is 8 and 8. Okay. So that was my first exercise, you see, after my second paper. And in fact, my first 3 papers, what I'm doing, as I look back on them, I was testing the sensitivity of these outcomes to the various conditions that I had, either in supply and demand, or I also changed the way people traded, the market rules, because I wanted to see how those were affecting things. So to summarize here, Jevons and Leroy had no theory of market price discovery. They had only this maximum utility maximizing theory of quantity choices. They imposed price taking, since people were assumed to be accept prices as given. They really were imposing a price taking form of behavior on the way they described equilibrium in the market. And they also imposed the notion of market clearing. Okay, that there would be one law of one price in a market that would clear. So they were really coming from the theory. They really weren't modeling the people in the market, you see. So Jevons thought, well, how would a market work? Well, it wouldn't work unless people had perfect information on his theory, you see, because he had no way of describing how otherwise. So he assumed that. Leroy imagined an exogenous agent, okay, an auctioneer who found prices and then announced them, and then everybody knew how much to buy or sell at those prices. Interesting, there was a famous debate. It was called the socialist economists, between the socialist economists and the non-socialist economists, in which the socialists argued that the state can find the prices. It's very easy to have a socialist state. All it has to do is operate like the Walrasian auctioneer. The state quotes the prices, finds out how much people buy, and then adjusts it until market's clear. So this is how, for example, Hayek realized in that socialist debate that surely it can't be that simple. Okay. And so he did a lot of his work on realizing that the pricing system is an information system, that what happens in markets is that the distributed values and costs of individuals get aggregated into a price, and that's a price signal that enables people to decide how to specialize, okay, in whatever activity they're in. If you read Marshall, he has a nice description of price formation in a local country corn market. And he's using none of the marginal utility stuff. He's going back to Adam Smith's chapter 7 and Bomboric, his farmers' price market, how farmers, horse market, how are they finding prices. That also is making no use of the concept of marginal utility. Okay, now so let's see how classical economists operated. Okay, so Smith talks about there being two concepts of value. There's value in use and value in exchange. And value in use is based upon, he described, effectual demand is based upon this concept of willingness to pay. Okay, value in exchange, the price depends upon entry competition. He described this, it's buyers and sellers entering into the market and contesting. That is what determines price. So the price of diamonds is very high because it's a monopoly. There's only one source of diamonds, and it's a particular area of Africa. So that there's not competing entrance into that market. On the other hand, scrap iron or water, the prices are much lower because you have multiple sellers coming in and contesting for that market, and that's how prices are formed. And on page 73 and 74 in chapter 7 of the Wealth of Nations, and I've just extracted a small part of that. Smith says that if the quantity brought to market falls short of effectual demand, in other words, there's a small amount brought to market and there's a lot of excess demand. Demand is greater than supply. Now, he doesn't describe that. I'm giving you a modern interpretation, but he has the right idea. You see, the right intuition. He says, if it falls short of effectual demand, those willing to pay the supply price cannot be supplied. Some will bid for what they can get and price will increase. So if the price is below equilibrium, it will tend to rise. You see, that's a dynamic statement. Also, at that low price at the beginning, the activities of people are constrained by the fact that at that price, supply or sales in number of units that people can sell is determined by supply. Or the number that buyers can buy is constrained by how much is offered on the supply. Okay. And then similarly, if the quantity brought to market exceeds demand, can all be sold to buyers willing to pay the supply price, and price falls. And up at the high price, sellers can't sell more than is demanded. So we always have, whichever side of the market is short, the supply or demand side, that determines, you see, how much can be exchanged. So that's an important part of the mathematics that's going on here in chapter 7. So price change, Adam Smith is saying that the price change has the same sign as excess demand. So we can state that mathematically. Secondly, at any price, quantity is limited by the minimum amount demanded or supplied. Okay, so those are the two kind of mathematical statements that come out of chapter 7. So here's the mathematics of it. First, there's the motivation. People come to market and they have maximum willingness to pay or minimum willingness to accept. The buyers are trying to buy cheap, the sellers trying to sell dear. That's the motivation part of it, and that's the data of the market. You see, all the data in the market is coming via this willingness to pay and willingness to accept conditions that buyers and sellers bring to the market. Price adjustment is dynamic. It's not the law of one price in the market. No, if we get one price, that's because of the behavior, and we don't want to impose that on the market. So all Smith is doing essentially is saying mathematically that the excess demand and the price change have the same sign. So if excess demand here, if we write it as E of P, that times the change in price with transaction number. Remember back in those experiments I showed you, when we plot the prices, each is a transaction, and we are plotting them in order. So T here is not time, it's transaction, because we're talking about sequences of transactions. Okay. So that the excess demand and price change have the same sign. That means it's positive. That assumes that the excess supply is not zero. You see, as long as the excess demand is not zero. So if that's positive or negative, the change in price has the opposite sign. Okay. Now let V of P, we're going to write, this is the same V of P that was in my original experiment. That's that, think of that as the integral or sum of the excess supply, the negative of excess demand. And remember, that's the profit. You see, that would be the profit required to sustain a price that's not in equilibrium, if you recall that diagram. Well, turns out that change in that profit with respect to transactions is just this product here. And so it's non-positive. And that tells you, you see that in this market, profits cannot get increased. They always are going to tend to diminish and decline. So that V of P, here's a function that's going to be minimized at the equilibrium price. So if the values and costs are discrete, we can just sum over the values among the for a price P, buyer I is able to get a value minus P that's positive, and a seller, you see the difference between the price and his cost will be his profit. So V of P is just a summation of these profits, and we're only counting the values that are above the price, not the ones below, because those would lose money, and buyers are not going to make those deals. So this sum and these indicator functions are just picking up those values that are greater than P, or over here, the costs that are below P. So V here is kind of a distance, you see, weighted by whether or not it's price is profitable or not. Distance between price and the trader's valuations, their reservation price. So it's a measure of distance and profit space. And here's the short side rationing principle. It simply says that the quantity traded is going to be the minimum of the supply amount or the demand amount. Now, total surplus will be V of P, but constrained by short side rationing. Okay, so this we can also compute here the surplus actually achieved by people as they trade. And I'll give you a chart of that here in a moment. Now, V of P turns out to be a function that's very important called a Lyapunov function. And any such function with these characteristics will converge to the center of value. We call P star the center of value. And that simply is the center here of value, the distance between the price and all of these values and costs. So we think of a market as going to its center of value, and normally that's treated as the equilibrium, but this is a generalization of that. So what's the price at the center of value? It's the price that minimizes V of P. Okay, so no buyer or seller has paid any more profit than it takes for him to give you an efficient market. Okay, P star is also maximizes this the surplus actually achieved by the buyers and sellers. It also maximizes trade, the volume of trade, and the volume of trade is the minimum of the supply or demand. And that, in the end here, we call this the principle of maximum information. Market price evolves so as to reflect value better and better. Constantly, things are getting better because of entry competition. Both buyers and sellers entering into this market and contesting, the result is that the value that people are achieving, it gets better and better. So the change in value here is always declining. It can be stationary at times, but it never gets larger. So this is the classical foundations of what Hayek and also Leo Hurwitz, the mathematical economist, talked about the informational efficiency of markets. So we're driving this, showing that that's actually in Adam Smith, although it wasn't really discovered until much later. And here's now charts of this. Suppose demand is a negative exponential distribution. Supply is a positive exponential like this, growing toward asymptotically toward some level like this. All right, and at any price here, trade is determined by supply. At any price up here above the center of value, the amount sold is equal to demand. All right, over here, here's this V of P function, and that's a minimum at the center of value. And here's the overall surplus actually enjoyed by the buyers and sellers. Gets better and better as prices go toward the center of value. Gets worse if they went away. In other words, if you're at a higher price, it'll tend to come back like this. And this is the way the convergence takes place. And this is a very smooth and ideal sort of markets. We've taken all the discreteness out of it. That's what we mean by a large market. In fact, all of these schedules will be stair steps. Okay, little stair steps because at each unit. And similarly, these will have flat sections in them. Okay, now I want to end on a few slides, 2 or 3 slides here, introducing assets. Because this is a market, you see, of where people are bringing goods to market and people are consuming them. Where does wealth come from? There has to be savings somehow in this market and investment if you're not going to just constantly use up wealth. So how should we model these? Well, there's a simple way to introduce savings, and you go to not Adam Smith's second book, but his first book, The Theory of Moral Sentiments. What does Smith say there? He says he provides a security motivation for saving, and it's a direct corollary of a fundamental asymmetry between potential gain versus potential loss. Smith says in The Theory of Moral Sentiments, we suffer more when we fall from a better to a worse situation than we ever enjoy when we rise from a worse to a better. So loss bulks much more prominent than gain whenever we suffer or enjoy either a loss or a gain. So so this leads, because of this asymmetry, security therefore is the first and the principal object of prudence. He says it is averse to expose our health, our fortune, our rank, or reputation to any sort of hazard. Now, let's apply that in this market. Suppose now that we imagine that there's a willingness to pay security demand for savings. And it could, even interest rates can be zero, okay? So to say there must exist an asset, let's call that capital X, representing stored goods. Now imagine it's corn, okay? Corn can either be stored or it can be eaten. So if you store it, save it, that's protection against bad harvest if you have a stock of corn that's stored. And then we also have a flow consumption of corn, call that small x, and that's the corn you eat. Okay, for a general equilibrium model, you see, with savings in it, we have to have at least one consumer good and one asset. And so this is the simplest general equilibrium world you can think of with savings. And so we have consumption, small x, saving, cap x. Those the prices are small p and capital P. And we have a willingness to pay for corn to consume, a willingness to pay for corn in storage to back up in case of loss of a bad harvest. Those are the demands. And also, what are sellers doing? They have a willingness to accept for produced corn. The corn might either be saved or eating, but they're producing, you see, corn for either of these two uses. So here's the wealth constraint. The value of the end period stock of corn, P cap X, is equal to the value of the beginning stock of corn that's when you open the period, plus the income that you earn during that period minus its consumption. That's the wealth constraint, okay? And and here's a simple chart to illustrate this. Over here on the left, here's the willingness to pay for corn stored. Okay, the period begins, and this is the stock of corn. Well, the conditions are such that that stock will rise. Okay, and there's a center of value here where this market will clear, in which the price of stored corn is equal to the price of consumed corn. I'm assuming there's no cost of storing it. Okay, if there's a cost of storing it, that would give you a distinction between, you see, the value of corn stored and the value of corn consumed. Okay, at that price, here we have a willingness to pay for corn to consume, and here's a willingness to accept for corn produced. The produced corn is X prime, consumed is X. So at this center of value, at this clearing price, you see, we have the real value of income in the period equal minus consumption. You see, that's savings, and savings has to be the difference between corn produced and the corn eaten, and that's what accounts, you see, for the increase in the asset value, you see, of the stored corn. So in a simple way, and you teach this to sophomores, okay, a simple understanding of a world where there, and this is also the macro, this world is a macroeconomic model. It's if you go back to the 14th century, 1300s, there were back-to-back crop failures. There were wet, very cold, wet springs in Europe, and huge numbers of people starved to death. Okay, there wasn't adequate storage to carry people through 2 years of a failure in the harvest. And believe me, people out of that world must have learned a lot about the importance of security, because the loss there is far greater than the gain. Okay, I'm gonna stop now and see if you have any questions. I'll leave this summary chart up there.
Great.
Okay,
Thank
Christian.
you. Yeah, thank you so much. Yeah, so I'll just let anyone, if you want to unmute, you can go ahead and just go ahead and ask your question, or you can drop it in the chat, and I'll ask the professor.
Well, there's a lot here, because it's all very familiar stuff to economists, but you see, it's being presented in a much kind of different way. And it's the kind of thing that we don't, I remember when I first started teaching economics at Purdue, one of the first things I realized that I didn't know the connection between economic theory, supply and demand theory, and what people actually do day to day in markets, what they do on the ground, you see. And that's, in fact, why I ran the first experiment I did, because I wanted to see if I could learn something about that.
Professor, we have a question in the chat.
Yes.
As I had mentioned in the introduction, you went to Caltech, got a bachelor's in electrical engineering, then you switched over to economics when you attended Kansas, and then you got your PhD in economics from Harvard. So why did you make that switch?
Well, because at Caltech, I took a course as a senior. It was a required course in economics. It wasn't until I was a senior. That's a good way to do it, actually, because we were fairly mature students. And I took a 1/4 course in principles of economics, and I was astounded. I had no idea that there was a field in the social sciences that actually had quite a lot of rigorous content, and that got my attention. And I'd pretty well decided at Caltech that I probably might not stay in most of the curriculum was physics, but I changed into senior year into electrical engineering. And so I was pretty sure I wouldn't continue in a engineering or science field. But I didn't know what I might do, and I discovered my interest in economics. And so I decided to return to Kansas, where I'd come from, and go to the university there because the tuition was far less than it was at Caltech, and I would get a master's degree in economics. And I figured that by the time I got the master's degree, I'd decide whether I wanted to go on in economics. And I did, and I never looked back.
Great. We have another question. It's actually from our advisor. Could we think of the movement of consumers or producers moving across locations as a source of temporary instability in the distributions of valuations in the local market equilibrium, and thus generating some pecuniary externalities in that transition to equilibrium?
Well, they're tending to move toward the markets and the activities that are most valuable to them. So that this is why that V function as a function of transactions is always getting better, you see. Now you can have a disruption like we had in the pandemic, you see, where people now are they can't go out unless they social distance and wear a mask. That's sort of impeding movement in the markets, and you see that caused a lot of distress in those markets. That they had market prices had to adjust, you see, to that situation. But so there's an external event changing the internal dynamics of those markets and changing some of those prices, you see. So I wouldn't say that that's an external event, but but it's affecting all markets, you see, in a similar way. And then these markets remarkably adjusted very quickly. Now one of the things that people marvel at is how quickly we were able to develop both treatments and vaccines for COVID-19. And why is that? Well, it's because there's a whole lot of investment been going on in the study of vaccines and the study vaccines and the study of treatments for various diseases like Ebola. Constantly studies of flu. Flu, you have to keep upgrading the vaccine. There's a lot of knowledge out there. It's not government knowledge, that's coming from markets. This is because people are investing in biotech and biopharmaceutical companies. And so the knowledge was already out there. It was simply a matter of speeding up the testing, you see. There must be, there's actually dozens of vaccine potential out there. And it speeded up the testing, and very early we got 2 or 3, you see, ready to go to market. That's because of what was happening in markets. And you were not aware of this. It's invisible. All markets, what's happening in them is invisible. And then it's the existence of those markets and those processes, you see, that enable the government very quickly to select certain tested vaccines and start to fund their availability to to consumer uses.
Great. Another question in the chat. In your opinion, what are some of the most interesting recent or upcoming developments in experimental economics?
Well, I think I would say, first of all, that's almost an impossible question for me to answer because there's so much going on and I can't possibly keep up with all of it. But I think experiments have become far more sophisticated, you see, than the ones I started with, because we now have these experiments, individuals communicating with each other through the computer monitors. It's very easy now to handle very large commodity price spaces. For example, in 1984, 85, that sounds like a long time ago, but it was only about 20 years after my first experiments. In 1984 and 85, we were doing experiments asking how you could use markets in the electric power industry to structure that industry. And we had a contract with the Arizona Corporation Commission to look at alternatives to regulation in not only electric power, but telephone and gas industries. And what we discovered in the laboratory, that people have no difficulty making a market in wholesale power on a high voltage grid. And one of our first applications of that work was in New Zealand and Australia. The Australians were interested in looking at alternatives to government ownership of by the states of the electric power industry. Why? Because their treasury was hurting. They were tending to lose money in those industries. Same thing in the United Kingdom. Margaret Thatcher denationalized electric power to help the British Treasury. They owned it and they were losing money in it. They said, let's get rid of this stuff, okay? And that there was a worldwide movement. The UK, Chile, New Zealand, Australia, Hong Kong, Singapore, these were all places where electric power was, the regulation of those industries was now depending more and more on markets. And the reason is that markets can regulate better because the information is fundamentally decentralized. No central manager, no czar of the electric power industry can possibly have all that information because it's out there distributed among all the consumers about what it is they want, how much and what they want to buy of electric power or gas, or in those days, telephone services. So, of course, in many ways, the easiest one to completely deregulate was telephones. You see, that used to be a monopoly based upon wires. Well, it's very easy to get entry competition in that market if you have a technology based upon portable phones, you see. So that the whole idea of regulating the telephone industry became ridiculous when you had buyers and sellers perfectly capable, you see, of buying a phone and contacting whoever they want to, and there was entry competition all over the place, and indeed, especially in the early days, more than one producer of the telephones. Okay, so you know, this world has changed tremendously, and it's because of markets. And the motivation came from the desire of governments to get rid of the burden of trying to manage those industries from the top down rather than the bottom up.
Great. Any more questions? All right. Thanks everyone for coming out. We really appreciated having all of you. Thank you again, Professor Smith, for speaking with us. We hope to see you next semester when we have our next set of speakers for the VEA. Thanks, everyone.